As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star then 0 on your touchtone telephone. I now hand the conference over to Mr. Nihal Jham from Nuvama Institutional Equities. Thank you, and over to you, sir.
Yes, thank you, Melissa. On behalf of Nuvama, I would like to welcome you all to the Q2FY23 conference call of Restaurant Brands Asia. From the management today, we have Mr. Rajeev Varman, Whole-time Director and Group CEO, Mr. Sumit Zaveri, Group CFO and Chief Business Officer, Mr. Kapil Grover, Chief Marketing Officer, and Mr. Prashant Desai, Head of Strategy and IR. I would now like to hand over the call to Mr. Prashant Desai for his opening remarks. Thanks, Prashant. Over to you.
Thank you, Nihal. Welcome everybody to this Q2 FY23 conference call of Restaurant Brands Asia. I hope you guys had a good Diwali. This is how we are intending to take the call today. I will first hand it over to Raj to make his opening remarks, a summary on both the India and the Indonesia business. After that, I will take you through the updates on the India business, post which I will hand it over to my colleague Sumit. Sumit will take you through the financial update. Sumit will then hand it over to Kapil to give you an update on marketing and on our tech piece, post which Sumit will take over the Indonesia side of the business, and then we'll open up the floor for questions. We intend to finish our side of the presentation in about 20-25 minutes, which gives you at least 30-35 minutes for Q&A. With that, I'll hand it over to Raj to take you through the opening remarks and an update. Over to you, Raj.
Thank you, Prashant, and good afternoon, everyone. Thanks for joining and giving us your time this evening. So let me just quickly summarize the India business first, and then I'll give you the Indonesia summary. So Q2 was a growth quarter for us. If you look at Q2 over Q1, we grew about 9% in revenues from 337 crores to 368 crores. That put us in H1 growth of 78.4% over last year. Last year, obviously, was COVID kind of constructed year. So 395 CR last year, and then this year we have done 705 crores. So we have grown over the quarter as well as half yearly over the last year. SSG was 27% positive. And half yearly, if you take it, it was 32% over the last year. So there's SSG growth as well as restaurant growth. Gross profit maintained a 66.4% gross profit, which is what we reported last quarter as well. And this is despite all the pressures on inflation and so forth, right? And then H1, if you see, we are at 66.4. This against last year H1 was 65.3. So we have seen 110 basis point improvement there as well. Restaurant level EBITDA, and I'm talking about post-Indias. We will share the pre-Indias numbers as well on our presentation. Q2 60.8 CR, that's 16.5% over Q1, where we had reported 49.9 CR, which is at 14.8%. That's a 170 basis point improvement. Half yearly, we are at 110 CR, which is 15.7. Again, a 14.4%, 130 basis point improvement over the 14.4 we reported last H1 of last year, which was at 56.8 CR. Company level EBITDA for the India business, again post India's numbers. For the Q2, we are reporting 42.1 CR, which is 11.4, against Q1, where we reported 33.2, which was at 9.9%. Is again a 150 basis point improvement. Half yearly, that puts us at 75.3 CR, 10.7%, which is again over 380 basis point over last year's H1, which was at 27.1, which is a 6.9% report on EBITDA. Restaurant growth, we are at 334 count as of 30th December. We continue to build restaurants beyond that. We have built another 6 this last month. Putting total growth for the quarter was 18 new restaurants that we built. We had some closures, so that gave us a net of 6 growth for the quarter. Now we have in pipeline 33 restaurants that are in construction. On top of that, we have another 60 that are ready to go into the pipeline into the construction. On the cafe piece, we actually more than double the number of cafes. We were at 86, if you remember last time, cafes. We added another 94 on that. That puts the cafe at 180. In fact, as we speak, we are getting very close to the 200 mark on cafes. BK app, again, marketing, Kapil is going to talk more about this, but we saw revenues growth of 33% quarter on quarter on our BK app. This is continuously 6-quarter continuous improvement and increase on the revenues coming from our BK app. 4.7 million app installs, which is again 26% growth over the last quarter. Liquidity stands good in the company at 460 CR. Quickly on Indonesia. Indonesia Q2 results 156.7 CR. This is a 2.9% over the Q1 numbers that we reported, 152.3. And what we had in Indonesia, I spoke about this last time when I was on the phone with you guys. Basically, two things we are doing in Indonesia. The first one is menu architecture. So we have aligned the menu architecture like we build in all markets with a very strong entry level like we have here in India, which Kapil will speak about in a moment. We have a stunner menu, which is at 50 rupees that we advertise, which is to draw and build traffic into the business. We have a similar parallel developed for Indonesia. We call it the Gokul menu. So that just got launched. In fact, it's a little over 2.5 weeks since we have launched that. And we have seen an immediate lift in traffic. I think we're doing, and this is without any advertising as such, just with some digital communication. We have lifted 20 traffic on that business. And then we have built a beautiful laddered menu as we do here in India, and then a premium menu on the other side. We're also going through validation on taste, on products, product builds and so forth with consumers. These are standard things we do when we take over a business. We actually go through menu architecture. The most important thing is the quality and the taste of the product. So we kind of go through that. So that's the phase that we are working on. A lot of work is happening. Sumit and Kapil has also been involved in helping the Indonesian team in traveling in and forth. So that's the first work that's happening over there. The second piece is, and we shared this with you last time, that our growth strategy in Indonesia has always been, in the past, in malls and so forth. And then in 2017, we shifted that. 2017-18, we shifted to moving into building restaurants, freestanding restaurants with drive-thru. So we continue to focus moving forward on that strategy to continue building the DK restaurants over there with both freestanding with drive-thru. Our work on product development on Popeyes is complete. We have finished testing the products. We are very happy with the results of the testing. The products are ready. We have started construction on a couple of sites. We are kind of planning to open about 5 sites before the end of this fiscal year. So that work is also on the way. And there's some synergies that we are working, that Sumit and I are working on, bringing the two brands of the Popeyes and BK that in the long term will give us some effective capex utilization, more efficiency in capex, as well as to make sure that we are complementing the business to grow the business collectively in that market. So that's basically on Indonesia. Not many numbers, as I've told in the past. We are going to take our time to make sure that we move towards a recovery and then beyond, because it's a fantastic market. I believe that market is going to give a very long-term good prospect for both the brands over there. With that, Prashant, I'll hand it back to you.
Thank you, Raj. Coming to slide 7, just to give you an update in terms of where we stand with respect to our our store openings both at Burger King India level and BK Cafe. If you will look slightly closer at numbers, one big strategic shift that we had taken during the beginning of the year was to have a much more evened out store opening strategy. As you know, earlier years, a large part of our store openings would happen in Q3 and Q4. If you look at our Q1 and Q2, we opened 13 and 18 stores respectively, which is about 31, compared to our 9 stores that we opened in the first 6 months of the previous year. So I guess that strategy is now beginning to gather momentum, and our belief is that next year you will see a much larger impact of a more evened out store opening strategy. Second thing, the team had looked at, combed through every single store economics, and we chose to close down 12 stores. Our belief is now we are done with the pruning of our store strategy, and going forward we don't see any major store closures as we speak. We opened our first cafe, guys, almost 1 year back in November of 2021. It's now been just a year, and we've opened, as Raj mentioned, 199 cafes. So it probably will be the fastest cafe rollout that the country has seen, and we continue to remain extremely buoyant and bullish about BK Cafe within Burger King. Given the traction that we have done, which is 94 cafes this quarter, we remain very, very confident to give you 250 cafes by end of this year, by which time we will have 390 Burger Kings. Raj did mention 33 stores under construction plus 16 pipelines, so we feel reasonably confident of giving you 390 Burger Kings by end of this year, and as you know, our next year target is about 470. So yes, we are looking at a much larger 24 and an even larger 25 as we speak. If you come to slide 8, this is a new slide that we have included. Over the last quarter, we've been meeting a lot of analysts and a lot of fund managers and people on the buy side all over the world. And one of the data points that they've been consistently requesting for is to just try to understand where we are in terms of our vintage, just to kind of compare our ADS with others. So as you know, we opened our first store in November of 2014. So the business is a relatively new business. We've been operational for a period of about 8 years. You take COVID out of the picture, it would probably be about 6 years. And if you then double click on that data, you'll see that our weighted average operations has been about 3.5 years. So all the numbers that you are seeing, just keep, probably it will help you understand those numbers a little bit better. Also, in 2019, just before the lockdown happened, we had opened 74 stores in 2019. Then we opened 15 during COVID, which were under construction, 50 more. And this year we've opened, some stores. So almost 50% of our portfolio is still almost, you can say, about 12 to 18 months old within this space. So it's all these are kind of things to kind of keep in mind when you decode through our data. Also the fact that we've opened cafes, also the fact that we've now started breakfast at our high street, and Sumit will kind of share some more data on this, just to give you and negate out the impact of all of this on the margins as well. So this is one more data that we were asked to share, and we are happy to kind of share this data with you. Coming to slide 9, our average daily sale weighted average at a portfolio basis for this quarter has been 127. As you know, September is a weak month for the entire QSR. As a result of this, what we did in last time when we came in July, if you take the weighted average of July, August, September, the number stacks up to 127. Delivery is at 43% and dining is at 57%. So that's kind of an update from my side, including the request to share the vintage. After this, I'll hand it over to Sumit to take you through the numbers, and then to Sumit to cover it. Over to you, Sumit.
Sure. Thank you, Prashant, and good evening to everybody. I just want to kind of talk about a few of the numbers which are key metrics that we believe are indicators of our performance. On the revenue side, Raj mentioned that we've grown by 9% on an overall basis, and just to kind of peel this a little more further, what Prashant was mentioning, we've got our EDS to move from 1,20,000 to 1,27,000. So of the total 9% growth that we got, 6% came from the growth of EDS. And we strongly believe with the initiative on concentrating on the stunner menu to the launch of cafe and the day part is what we've literally been able to kind of help push the EDS up from 120 to 127. So that's something which we very clearly see it as a positive. And this, to our mind, is the base for us to build on from where we stand today. Looking at gross profit as one of the other indicators, we've always been kind of going through the difficult times of inflation. We've always been on the positive trajectory over the last few quarters. This quarter, again, we are kind of maintaining the gross profit at 66.4%. With the initiatives that we have on the category side, we strongly believe that our target to get to 67% for the year and taking it to 68% the year after, we believe that we are on the path to that as far as the gross profit margin journey is concerned. At the back of all the investments that we've done initially, in the last quarter we mentioned that we put some money behind marketing. We did see the result of that in ADS. Our store level EBITDA moved up to 8.2%. Prashant, was kind of hinting towards some of the investments that we have made during the quarter towards cafe, towards day part and all. And just as we've seen our ADS moving up, but that also has required us to kind of make some upfront investments on some of the cost lines, especially on the lines of people, as well as the increased cost on the utility side. As we kind of see and as this business kind of builds up, we've seen in the current quarter, roughly both these lines have an impact on our gross margins or EBITDA rather by close to 2%, which we believe that as the business scale kind of building, we should see that improvement coming onto our P&L. Similarly, trajectory on store EBITDA is also reflected in company EBITDA, which has moved up from 1.1 to 3.2%. And our corporate cost, we continue to maintain at 5% of our revenue. So that those are broadly the financial key metrics as far as India business is concerned. We strongly believe that we are poised for growth and improvement in revenue as well as on our business performance going forward. With that, I'll hand it over to Kapil to take us through some of the initiatives that we've taken and which we'll continue to take our growth forward from here. Yeah, thanks.
Well, thanks, Sumit, and good evening, everyone. The last quarter was very focused on continuing to drive dine-in growth on the back of the Stunner program. And as you noticed, our EDS has improved over the last 3 quarters from 104 to 120 to 127. We stay focused on our strategic pillars of driving a strong and sustainable value proposition, building and promoting a very differentiated and unique menu, building variety of beverages to cater to the emerging consumer needs through BK Cafe, and building incrementality through that. And finally, creating a strong digital ecosystem which allows the customers to access the brand digitally in every channel, whether delivery or dine-in. So I'll start by talking about the Stunner Value program. I move to the next slide, number 13. Quick recap for everyone. The 50 rupee Stunner menu is an everyday value menu with a range of products at 50 and 70. So there is a choice of format and taste for our guests, and this is a profitable layer and sustainable over time. Now we have seen the Stunner menu volumes grow by 50% ever since we launched the offering. Customers have given us very good feedback on variety, taste, and quality of these products. And this has been on the back of a sustained promotion. The most recent campaign started in mid-June with the celebrity Hrithik Roshan, and we ran it through July and August. Now on slide number 14, I'm sure you came across the headline that Burger King has hacked Hrithik Roshan. Now that campaign went viral, and it was a very unique campaign done in our own BK style, where we hacked celebrities' daily life and created a lot of buzz. Given where the consumers are, we focus a lot on digital and social media to promote our campaigns. in addition to the conventional impact television, BTL and OH branding programs. On the back of this campaign, dine-in traffic saw almost 20% improvement in the pre to post campaign periods. Slide number 15 talks about how Whopper, which is our most core signature product, continues to be a leading product in the category. We continue to offer consumers new innovation and taste experiences with the Arabic and the Masala Whopper, very unique products, one inspired by Middle East cuisine and one inspired by very local Indian cuisine. And that allows customers to come back, and improve their frequency. The second part of the Whopper on slide number 16 is where Whopper continues to be the voice of the brand Burger King in social conversations. Our brand has established a very unique, youthful and quirky personality to connect with our consumers and has a very, very engaging social feed. Whether it's about events like cricket, movies, technology, or informing our guests about the fact that all Burger King products and menus that we develop here is free of synthetic colors and artificial flavors. We have all these conversations on our social media with our fans. The third pillar that I will talk about is the strategic menu layer of BK Cafe. Now slide number 18 in the deck. We continue to rapidly ramp up cafe expansion and are well on course to opening 250 cafes as we heard. The cafe stores continue to drive 7% incremental sales and help us explore and develop new day parts like breakfast. Now, this is a very new concept, for us. We just scaled up, in the last, 12 months. In the last few months, we started to push for cafe awareness on social media and other engagement platforms. So, for example, celebrating the International Cafe Coffee Day, which is on the next slide, we held a lot of events in mall atriums, did a lot of social media promotion, influencer marketing to drive awareness about the fact that we have now a new concept called BK Cafe. The last update I want to share on the next slide is about the BK app. We continue to grow sales and downloads on the BK app, almost by double digit in the last 6 quarters in a row now. We will continue to build this platform as a channel for Burger King fans in the future and as a strategic advantage for us in the long term. The next slide is just a summary of all the recognitions and awards that we've got, in the last quarter for the work done on digital and mobile marketing campaigns, moment marketing, and the recently, held Brand Equity Shark Award where we won the silver for best use of mobile marketing. This was for the cricket hat campaign that we run in Q1 of this year. With that, I would now hand it back to Prashant to talk you through the outlook.
Thanks, Kapil. Guys, our outlook more or less remains the same, except the fact that with so many cafes opening, we believe we will probably be at the higher end of the same-store guidance for next year, which should be double-digit plus going forward. Despite the inflationary trends, given the way we've managed our product mix and our cost, we remain confident of giving you a 67% gross margin this year and 100 bps over that next year. On the cafe side, as we had guided last time also, we'll end this year with 250 cafes, and next year we plan to open another cafe, take this to 350, by which time we have total Burger Kings of 470. So no major change in guidance that way. I'll then hand it over to Sumit to take you through the update on the Indonesian side.
Sure. Thanks, Prashant. I'll just quickly talk to you about the Indonesia business. Raj in the initial update did cover Indonesia to a fairly large extent. As far as Indonesia is concerned, we did open 5 stores during the quarter and shut down 1. All of these were freestanding drive-thrus, and we've spoken about this, that as we go along, our growth strategy would be revolving around freestanding drive-thru, and we will see the portfolio to kind of move more and more directionally towards that. As far as average daily sales is concerned, we still remain in the region of around 98,000, and that's one focus area for us. And various initiatives, largely starting with complete menu architecture, which kind of we've reflected in subsequent slides, and I'll just talk to you about that. To realignment of the portfolio, which we believe should be able to kind of help us get back to the normal levels of ADS in terms of pre-COVID levels. If we really just do a little bit of deep dive in the numbers, yes, the revenues have remained flat, but at the same time, with the menu architecture, kind of redefining the value strategy in Indonesia, we did make certain investments on the marketing side towards later part of the quarter, and which we would continue to do as we go into this quarter as well. We did see the company EBITDA on the negative side, the loss to kind of expand. But this we believe should only help us as we go along, because the large part of the investments has gone towards spend on the marketing to help build the brand. So that's one part which we feel that should help in the long run as we go along. As far as go forward strategy is concerned, as Raj was mentioning, the key part is effectively to rebuild the entire menu or reposition the entire menu. We've gone live with the value part of the menu, which we call as Gokil, and the early results that we've got seems to have been very, very encouraging. Now our next part of the strategy, which we would roll out on the menu side during the quarter, would be to reposition the core of our burger menu, which would be led by Whopper. And then there is, as far as Indonesia market is concerned, it's fairly deeply penetrated on the technology side. We have the advantage of a very strong loyalty customer base, standing at 6.7 million. We would further invest on the CRM side to get more traction on the customer side as far as the loyalty is concerned. So that's a quick brief on the loyalty on the Indonesia side. So with that, I'll hand it over back to Nihal to open up for questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If your questions have been answered and you wish to withdraw yourself from the queue, you may enter star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, you may enter star and 1. We have the first question from the line of Devanshu Bansal from Emkay Global. Please go ahead.
Yes, sir. Thanks for the opportunity. I just wanted to understand an impressive gross margin performance. So, in my view, there have been likely two headwinds. One is our delivery mix has reduced in favor of dine-in, and the second one is we have gained strong traction in standard menu. And despite that, on a YOY basis, our gross margins in India business have improved by about 100 basis points. So just wanted to understand what has led to this. And in H1, we are at about 66.4% gross margins, and we have retained 67% gross margin target for the entire year. That suggests an improvement in H2 despite some raw material inflation. So just if you could cover these two questions, it would be helpful.
Thanks, Devanshu. Raj has been consistently been communicating with investors and analysts alike that when we look at gross margin, it's a function of both the numerator and the denominator. A lot of people often look at just the denominator and what's happening on the cost side to evaluate gross margin. One of the things that we've been doing consistently in Burger King in India ever since we started was to build a very balanced menu architecture. We have a standard menu which is up to 50 rupees. Then we have a classic menu anything between 51 to 100, and then we have Whopper 101 to 150, and then we have the King's Collection at 150 to 200. Our ability to first acquire a customer at a standard level and then keep migrating him across classic, Whopper and King's Collection. Our current understanding and belief is that this is something which is playing out to our advantage. This is also besides the fact that we've just started cafe, and our hope is that with the way we are doing on cafe next year, you will see a push on the gross margin coming from cafe. So product mix has been a very critical part of our gross margin strategy. Second, as you know, we like to open our stores within clusters. We've repeated this in the past that 70% of all our new stores open in the same city. What that does is, let's assume we have a city where you have, say, 8 stores or 9 stores, and I open 3 more stores. The same truck that is going and delivering product with 7, 8 stores now delivers to more. And in our case, as you know, our cost of goods sold includes the distribution cost. So as we open more stores within that same city, there is a leverage which comes to us by way of distribution cost, which obviously gets reflected in gross margin. Third, again, as we keep growing in scale and in size, and now with the Indonesian business also being acquired, which we are now trying to explore the possibility of sourcing ingredients and raw material from India, our ability to now sit across the table and discuss and negotiate with vendors will probably go up. So as a result of this, we've been able to maintain our gross margin. Normally, you will see us that if we are saying 67, we will probably want to outdo that. Unfortunately, because of the inflationary pressures this year, if we are not being able to outdo, we remain confident of at least delivering a 67% gross margin.
Great, sir. Great, Prashant. That's encouraging. Secondly, you covered it a bit, but still wanted to understand. Versus Q1, our ADS has increased by about 6-7%, and we had some 220 basis points of one-time marketing expense in Q1. So adjusted for that, still we are not seeing any sort of improvement in the store level EBITDA margin. So what potentially were the reasons for that?
So there are two things. One, my colleague Sumit tried to explain. What happens is when you're opening 200-250 cafes in a year, anywhere between 2 to 3 baristas or 4 baristas per cafe that you need, all these people need to get trained. Over and above that, we are opening 80 Burger Kings, so you'll have another 1,200-1,300 people to train over there. All this training cost somewhere has got incurred last quarter, this quarter, and you will see this impact at least for another couple of quarters. So what happens is still the ADS will go up with a little lag. So today, if you look at my people cost would have been higher by about 150 basis points as a result of this initiative. Second, as we opened cafes, we started breakfast for all our high street restaurants now open at about 7 o'clock. Now the breakfast ADS takes 12-18 months to kind of build up. Today it's only about 2-3% of our day part, but over a period of time this will be a very large, meaningful part of our business. But we have to open the restaurant at 7 if we want to build that business. So there is another 50 basis impact on that coming on the utility side. So these two alone, will push my EBITDA margin at a store level to a respectable level this year. One thing, one of the reasons why we showed that slide on our weighted average store, we are still a 3.5-year-old company, right? Our ADS today stands at 127. As you keep moving forward and your ADS keeps growing basis the same store guidance that we have given you, and then coffee begins to kick in, what you will see is as your ADS keeps growing, there is a disproportionate operating leverage that kicks in. 1, gross margin, 2, rent, 3, people cost, 4, utility. All of this next year will give you a store level EBITDA margin which will be significantly better. So just I would request you guys to be a little patient for the next 2-3 quarters as the business scales up, as all these new initiatives begin to reflect in the ADS, we'll catch up on the margin front as well.
Got it, sir. And last question from my end. We closed 12 restaurants this quarter. Where is the cost associated with these closures? Where does this cost sit in? As in which line item?
So one is the capital cost with respect to LHI. We kind of accelerated the depreciation up to date of closure, so that would sit part of largely that cost would sit part of the depreciation line there. That's how it gets represented.
So versus last quarter, I guess depreciation has still reduced. So were there? So can you explain that? So earlier it was around 33-34 crores. And last quarter it was 46, and this quarter it is 43. So, but closures have been in this quarter.
So as I was explaining actually that we, once we decide from the perspective of closures, we start accelerating the depreciation from that part. So a good part of the accelerated depreciation went in last quarter itself, and some of these stores were closed in the early part of the current quarter, around July, August or so. That's why while you are seeing the drop in depreciation, the closure related depreciation cost or the cost is sitting in depreciation line. It's just that it's a substantial portion did get recorded in quarter one, and a small part of that came in quarter two. So that's the reason why you are seeing that.
These are planned closures, right? At some point, you decide that you are going to close these restaurants. Obviously, it takes a little while to put all your agreements and everything in order before you close the restaurant. But what you start doing is to accelerate your depreciation before the closure date. So it takes usually closure lags behind the cost depreciation. So that's why you saw it in previous quarter.
One other thing, they also, since you are talking about the closures, this was a detailed evaluation that we did during the early part of the year, and kind of decided to take a decision to carve out the portfolio which was not doing well for us. Now as we now stand, we are now sitting on a very strong, healthy portfolio. We feel that we will not see as we go along over next from here on for at least 3 to 4 quarters.
Got it, sir. Thanks a lot. Thanks for taking my questions.
Thank you, Devan.
Thank you. We have the next question from the line of Palak Shah from Infina Finance Private Limited. Please go ahead.
Hey, hi. Thank you for taking my question. So just first, is in the thought process, what are the criteria when you look at the store closure or a store success?
Criteria for store closure?
Yeah, so obviously, if a restaurant does not have potential to increase revenues, past the average revenue of the business, and there's sometimes other important things like when we are offsetting a restaurant, there's a better site across the street or down the road. Then what we do is we offset that restaurant, build it in the newer site, better site. If the synergies have gone there, we move the restaurant there and close the restaurant in the old place. So there's multiple things that we look at that we take into consideration. Like if you look back at our 8 years, we have closed maybe 6-7% of our restaurants, well below the 10% industry kind of standard. So we have been opening restaurants, a lot of due diligence, and closures are always good when they are not profitable or useful in the long run. So those are the kind of things we look at before we close the restaurants.
Also, just to add to what Raj mentioned, given a lot of our capex investment happens at the kitchen and then the furniture, almost 2/3 of the capex when we choose to shut down the restaurant is recovered by us. So to that extent, as a discipline, if we feel that the restaurant may not be able to do the numbers we think it would do when we sign off the restaurant after giving it a certain amount of time, we will then be disciplined enough to close it down.
Got it. Thanks. Just one more question on the quarterly margins. If you look at last quarter, you had 2.2% additional expense towards A&P spends. But given that will be more normalized this quarter, despite of that, we are not seeing any material change on a sequential basis. The EBITDA margin both at store level as well as company level. I understand one of the reasons they explained was the additional spends towards the employee cost or employee training. Just want to understand if there is something else that can drive this in the ensuing quarters.
Yeah, we've been saying if you look at our business, even from a near-term perspective versus a medium-term and a long-term, there are 4 broad operating leverage levers at play. One, we believe that our longer-term direction is to take our gross margin from where we will be this year, 67 to closer to 70%. Second, rentals currently sitting is at about 13.5%. Our view is as we are opening more and more stores, the current threshold of stores are all being opened at about 10% rent to revenue plus 18% GST. And as your ADS improves, your rent as a percentage of revenue will come down. So there is a second lever of operating leverage that you will see at play both in the near term and also in the longer term coming from rent. That's the second operating leverage. Third operating leverage, what Sumit was mentioning is currently our people cost will be about 150 to 200 basis higher than a lot of our peers. That is as a result of two things. One, because our ADS currently stands where it stands. As you do more ADS, your people cost as a percentage of revenue will come down. Last couple of quarters, because of all the training of our baristas as well as the new store, you've seen a little bit of a slightly higher impact. Fourth is our utility cost. Utility cost also, there is a smaller impact in terms of operating leverage, but there is a certain amount of operating leverage that we can take there. And the last lever for us when it comes to operating leverage is our corporate cost. As you will see, as we open more restaurants, our restaurant growth will move this year from say 390 to about 700 by December of 26. But with the growth in ADS, you will see our top line growing far aggressive than our restaurant growth. As our ADS growth goes more aggressive than the restaurant growth, all these operating leverage coming into play. So corporate cost as a percentage of revenue will come down significantly. We don't expect our absolute corporate cost to go higher than about 10% every year. So now when you factor all these four pieces, and you will start seeing, shades of that, which is what Devanshu also asked, starting, end of this year and entire of next year, you will start seeing all these four levers playing out.
Correct. Just on that, the point that I'm trying to make is that if you look at just the point on the corporate overhead expenses, this quarter itself on a sequential basis has gone up by 9% and at 20% on a YOY basis. And just subtracting the reported restaurant EBITDA minus the corporate EBITDA that you mentioned. So that's where the operating leverage is not, we're not able to see the operating leverage benefit that should be accrued.
I know, yeah. If you keep looking at quarter and quarter, then we get into so much of semantics. But broadly, if you look at it here, the entire team that we have over here, as we keep growing, do we see significant addition to a senior leadership? Answer to that is no. Will we keep adding supervisors and staff over there? Answer to that is yes. So 10% is a fair number to assume in terms of our corporate cost going up. So 70 crore number will next year probably go to 75 or 80 crores. Will that 70 crore number go to say 90 crores? Answer to that is no.
Got it. And just lastly, on the Indonesia business, last time you mentioned this was July 22 exit ADS was 105, but this quarter the reported ADS is just 98,000. Is there something specific that we have taken an initiative that has led to this drop, or this is more structural?
So yeah, July, as you know, right, once the Ramadan gets over, there is a period whereby, the whole country opens up and people kind of come and celebrate in a bigger way. So July was largely because of that. But let's be fair here. Has Indonesia delivered to our expectation? Answer to that is clearly no. Our earlier understanding was that, and we spoke to you guys and we mentioned that, by September or latest by December, we expect full COVID recovery. So we will go back to our pre-COVID. Currently, if you ask us, we believe that instead of December, we are hopeful that by March we should be able to come back to our pre-COVID. So what we are doing internally, as Raj and Sumit mentioned, are two things here. We are doing a lot of work on the menu and the menu architecture, and its resultant impact on the gross margin. Our gross margin when we acquired this business was about 57.5. We've already been able to take this from 57.5 to 59. And gross margin sitting at from where we are is a very important qualitative metric that we drive, because in our view that is a very, very important part of how well you are running the business, because a lot of the other things sitting below gross margin are all linked to ADS. If your ADS grows, those numbers will come in place. But gross margin is something that is under your control. So that's one area where the team has significantly kind of spent time and work to pull that up. We believe that we'll still further take this to closer to 60 by the end of this year. Second thing we've taken a call once we went there and did a lot of work is, over the last 4 years, the company in Indonesia had a little bit under-invested on the marketing side. They were not present on television. As we see recovery picking up, we are ready with a Hrithik-like celebrity there. We are playing on the front foot here, and we will take the Indonesian business to television, and we are hopeful that 24 will be a very different year. But yes, in some ways you can say that we are running 6 months behind the Indonesia side.
This is the operator. Mr. Shah, does that answer all your questions?
Can I just one more question, if you don't mind? Just on the Everstone stake, there were media articles mentioning that Everstone is looking to sell this entire stake that it holds in Burger King. Your thoughts on this, please?
Yeah, as when we had done the roadshow, we had guided all investors that 23 their fund line gets over. So I think the process will start. We as a company are yet to hear about that, but at some point of time they will make an exit. As we had mentioned this during our roadshows at the IPO, the exit is going to not happen in the public markets in India. The exit is going to happen at the F&B Asia level, which is in Singapore. And we were at that point of time given to understand was that when they exit, either a large financial sponsor or a strategic guy will come in. But yes, it will be fair to say 23, 24 is somewhere where you will see that process unfolding.
Correct. Great. Thank you so much for this, guys. Thank you.
Thanks, Palan.
Thank you. We have the next question from the line of Sabyasachi Mukherjee from Centrum PMS. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is, in lines with the previous participant. See, I just wanted to understand that what is the issue with the Indonesia business, because, pre-COVID we were doing, 135,000 kind of a ADS number without the menu alignment, without the advertising spend, without the celebrity endorsement. But now we are struggling. I mean, it's COVID is gone. What is the issue over here?
Thank you. This is, I think Prashant did explain that very articulately, but I'll take another shot at it. Look here, there's a couple of things. If you remember, when India's COVID opening had started, and it started slowly and it kind of gradually opened up, right? It was state-driven, it was driven, malls came in, then the offices and schools and colleges. So it wasn't a switch that was flipped in one day. It took over time as the business kind of opened up to the customers. So it was a process. And we also shared with you last quarter that Indonesia was about 3-4 months behind India in terms of opening up. So that's the first thing, right? So they're kind of little on the lag. Now, here in India, when we were in the COVID stage, there's a lot of work that was done on menu architecture. I mean, most of the companies and ours specifically, we did a lot of work in restructuring and putting our menus and planning to come back post opening post COVID. So that kind of work is going on in Indonesia, right? So the 135 was there, and the potential is significantly higher than that. But that's the excitement about the Indonesian market, is there's a potential to drive that business significantly as we see, that opportunity. So there's a lot of work we are doing on menu, and you will understand that in our business, it all starts with menu. Starts with building a quality menu architecture, filling that menu architecture with the right items that are tested, by the consumer, that have all the checks and boxes ticked. And once you have that structure in place, and menu architecture is just not about quality in food, but it's also about pricing. It's about setting up a parameter that is the work that is going on. So that's why we said we will need some time to make sure all those things are in row. The recovery over there is just in the process of getting in there. The industry over there is kind of in line with the recovery process that we see at our Burger Kings over there. Maybe slightly better in some of the businesses, but predominantly in line with what we are experiencing. So you will find that as this thing is kind of behind us, that when we open up, fully, and we are fully structured moving forward, that we have a proper menu architecture in place. We have a campaign in place to come back hard, like Kapil had here in India. He had a fantastic campaign lined up with Stunner. So those are the things that we're putting in. So the initial thing, the first thing that we did over there was Gokul, right? I spoke about that in my opening, which is the Stunner for Indonesia. So menu architecture again is about bringing people into the business, graduating them over time period, and building indulgent menus for those occasions, right? So that storyline is we are building on it. Punj, our CEO over there, is not today with us. He's on the road and could not make it to the call today. But he's working diligently with his team. We have the new CMO there. A lot of contribution from Kapil over here, who is also helping out with the menu architecture and so forth. Our head of operations also was there for a few days to kind of guide on the opening process. So this will take a little while, but this is a very strong business. I'll tell you, as I spoke a quarter ago, I am fully convinced about this business. I feel this is a strong business with very good economics. It has a very good rent over there. So if you look at the rent in our portfolio right now, we are kind of moving. We brought it down from 15 to 14 to 13, and we are kind of moving it towards 11. That business already sits at an 8.5 kind of a rent. And that's the kind of business that is. The cost of sales on delivery is significantly lower. So there are some intrinsic advantages to that business that exist, and the rest is about just hard work and getting it back in there. Yeah. I hope that answers your question, right?
Yeah, and follow up to that is, how long will it take for all these exercises to kind of be in place and you reap the benefits out of it?
Look here, we will carry you through the journey. We are with you every 3 months. We are on the phone every 3 months. Let's just carry you through the journey. Let's not make a forward-looking statement on the call. Let's just carry you through the journey. We are working very hard. We are working with the team over there. There's a lot of work going on, and we'll keep updating you.
Sure. My second question is on the India business. So if we look at on a sequential basis, Q1Q, there is a 9% growth, and out of it, 6% has come from ADS growth, as you mentioned in your opening remarks. I just wanted to understand that, so we have done this campaign on the Stunner menu with Hrithik Roshan, and also BK Cafe, the count has increased. All of this could only increase the ADS by 6% only. Is that the number we can achieve, or we can achieve far more?
So there are two things, right? One, the number is what it is, which is 9,000. Yes, we've opened almost 190 cafes, but if you look at on a weighted average quarterly basis, of that 7,000 incremental ADS, the cafe contribution would be about 2,000 rupees. But the bigger piece to look at it is cafe is doing an incremental ADS of about 8,000 to 10,000 rupees. And if you just multiply that number into 365 days into 250 cafes that we will have at the end of this year, you will get a sense in terms of the impact of cafe next year, considering the fact that it is at a much significant higher gross margin compared to that. So from that perspective, keep that in mind. Number two, we are still guided for a 25% same-store growth rate. Sometimes what happens is when we have one very good quarter, people expect that every quarter we will have that kind of. And it's not just us, right? The July, August, September quarter for the industry as a whole is a softer quarter. So will it be fair to compare it to June? I don't think it's a fair comparison to make that comment a basis. That I think look at our business slightly more on an annual basis. We'll deliver you a 25% same store.
We are guiding 10% next year anyway.
So I understand that September is a weak quarter, but if I may know, how has things been in the October and the first 10 days in November?
October, as I said, right, October is the build-up of for us, all QSR, December is the biggest month. So yes, as we enter December, we are all also hoping it's our big month. We'll have a lot of store openings that have happened. So yes, looking forward to December.
Okay.
Yeah,
Last question.
we are guiding sales SSSG. You've seen that on Prashant's slide. So we'll continue to grow there. We have told you that the cafe is adding about 6-7% incremental sales. Our intention over there is to continue building that. So you put all these building blocks. So the intention is not that we do one Hrithik Roshan campaign for a quarter and then we're done with it. This thing just keeps going forward, right? It's a scale business. It's not only number of restaurants we build, but the amount of sales we've built over time within the same restaurant, right? So you will see all this coming through as we build it. Okay.
Thanks, Abhay.
Last question is.
I'm really sorry to interrupt, but we have participants waiting, so I would request you to come back. Yeah, thank you. We have the next question from the line of Dheeraj Mistry from Antique. Please go ahead.
Yeah, hi. Congratulations on good sets of numbers. So my first question is regarding inflation. So what kind of inflation we are facing on capex, and what will be the current run rate or current capex per store right now?
First of all, we did see some headwinds in the early part of the year, which is now slowly starting to kind of settle down as far as the capex-related inflation is concerned. That is one. Secondly, a part of the inflation impact which we are seeing, we are also trying to address through re-engineering the assets that we kind of put at the store. That's one. Secondly, we need what Prashant was talking about. For us, literally speaking, the scale is shifting for us. Earlier, when we were buying assets, or for that matter, anything, we were literally buying for India. Now we've consolidated the entire asset buying for India and Indonesia on a consolidated basis. So while there is headwinds on the inflation side, we've also been able to, in some form, mitigate it in the manner of scale. Increasing the total scale and the buying that we are doing for both the geographies. But otherwise, average inflation on the capex side has been around 4 to 5% as far as we're concerned. Roughly, on an average, we spend around 3.2 odd crores for the purpose of setting up a store. And I'm talking about more from the perspective of high street stores, which is what are going to be our strategy way forward. And this also includes the incremental spend that we put for setting up the cafe, which is in the region of around 20 to 35 lakhs. So that's broadly the capex spends that we have.
Yeah, thank you. That's very helpful. And second, I understand that management is completely independent from the promoter. Our day-to-day activity is not being interfered by the promoter. But in any way, stake sale or overhang of this will impact our strategy to expand, or will it impact our day-to-day operation in any way?
Yeah, hypothetical question, Neeraj. So my answer will also be a little hypothetical in that sense. So two things, right? If you structurally see, the store opening guidance is defined by our master franchise development agreement. So irrespective of the change that happens, that will not change. If somewhere in 2023 and 24, when assuming there is a change that takes place in terms of control, a lot will depend on who's coming in. But if you also structurally see, we've been running this ship pretty well and pretty efficiently. I don't see a reason why somebody will want to come and disturb a ongoing ship that's doing well. Because, ultimately they will also pay top dollar for this asset, right? You don't pay top dollar, come and then kind of disturb a well-run ship. So hypothetical, neither in that sense. All I will request is just to wait and watch, still some time to go.
Sure. Thank you. That was my last question.